All right. It is July 18th, and we are coming to you with another update on the markets and really just another way of looking at what's happening in the world. We are Team Equi. We are bringing the future of alternative investments to you. We are equal parts hedge fund and technology platform, but today we are here to focus more on what is happening in the world and why it's happening. So I have with me today Itay, our Chief Investment Officer, and I'm hoping you can help us read the tea leaves. There's still a lot of exuberance in markets, and people are a little bit confused. There's conflicting narratives, and I'm hoping you can help us piece through it. So what do you got for us today?
Thanks so much, Tori. So I know usually in my calls, I'm a little even-keeled, and I try to present both sides of the argument and how things could kind of progress. Because at the end of the day, financial markets are not certainties. They're all a matter of probabilities, right? We think about it in the term of what is the likelihood of X event to happen versus this event is going to happen. So today I wanted to present some of the pieces of evidence that I can put together to give you why we believe that the probability of a recession, a hard landing, and kind of not the best economic outcome is the higher likelihood than not, despite what you're hearing in the media. So I'm going to go on a limb here and say that I do think that the higher likelihood is for that to happen. And I want to share some of the data points that leads me to think that is the more likely outcome. So I think this would be a more interesting call where we're going to lean on to the bear case.
Great. Okay. And this is, I think, useful because a lot of our audience is imagining, how do I position myself to survive this, crisis and come out the other side better than I went into it? And that's not, not easy, but it can be done. So why don't we hop into it?
Wasn't the Japanese word for crisis opportunity or something like that?
I think you're right.
All right, let's do it. So I'm going to share my screen real quick here, and we're going to go through our presentation.
Let the charts commence.
So first off, the key question that we should be asking is, are we headed towards a soft landing, which is kind of the going narrative right now. So what is a soft landing? Soft landing is this idea that the economy can avoid recession. It's this idea that the Fed gets things just right, the economy slows down just enough for inflation to stabilize, and we don't get a recession. A lot of market participants are believing in this right now, but I think it is a mistake because they're primarily looking at lagging and coinciding indicators, and they're not paying as much attention to leading economic indicators that I think are more important when determining these type of things. We've also had the AI mania come in and really move the markets to the right tail, really focusing trillions of dollars of gains in just a few number of stocks, creating a little bit of a shock to the system on the upswing. And we've seen a lot of disconnects with many, many indicators that we're going to cover. And we're really going to try to answer that question of whether or not a soft landing is likely, or we are indeed just delayed on the hard landing call that we've had before. So again, many articles like this are coming up. This one from just last week in the Wall Street Journal, talking about inflation slowing down and soft landing odds continue to improve.
It's not just Wall Street Journal. I'm seeing it all over Twitter. I'm hearing it in conversations. The narrative really has shifted, and it's wild, right? It wasn't that long ago that it was all doom and gloom, but now everyone's saying, wow, it looks like the Fed pulled it off.
It's almost like price drives sentiment, right? Which is exactly what it does. Price tends to drive sentiment, which is not necessarily the smart move. So I want to talk about the broader investment cycle, but here I'm not going to talk about the investment cycle the way you think about it in the business cycle and contraction, expansion. I'm going to talk about the psychology of the investment cycle, because at the end of the day, behavioral economics drives a lot of what we're seeing. And in this investment cycle, I think it's quite interesting. This has been researched time and time again. I don't know if I ever told you, but I wrote my thesis in university about the behavior of bubbles. So I actually studied anything from tulip mania to the South Sea bubble, to the Asian financial crisis, to the dot-com bubble. So I try to see this recurring motive of how these things kind of play out. And you see this continuous classic pattern emerge when it's really, and I'm not calling necessarily a bubble, but an investment cycle, a full-on investment cycle. It usually looks like this, where in the early phase, the smart money really starts accumulating, but it's not really going up that much. The trend is really sustainable. And this is the trend in this dashed line here. Then the institutional investors start coming in, you get the first sell-off. And then when the public realizes things go up, you're starting to get more media coverage, people get really excited, the greed comes in, the delusion comes in, and then the new paradigm is where things usually top. And how to spot the new paradigm? Well, it usually comes with those words, this time is different. This time is not going to end in a bad way. This time is clearly different. We have a new, and I can go back and track back in history. So for example, in the railroad mania, railroad technology is going to change the world because all of a sudden we can transport things so quickly across the continent. But guess what? The railroads were overbuilt and there was just not enough cargo for all the railroads to be. So the new paradigm was, in fact, yes, you have a new technology, but you're pricing in 30 years of progress in a very short period of time. .com was very similar. So this time is different mentality. So my opinion is 2021 was very similar to that, with many narratives of this time is different, valuations don't matter. And it's usually accompanied by a period of low interest rates. Then you get the initial sell-off, which is really denial, right? This is not really happening. It's a little dip, and you should buy the dip, and you should basically participate again. And then the quote return to normal phase. So the big question that I'm asking is this the return to normal phase before things really deteriorate? And that's what I'm going to try to answer here. And we've seen multiple return to normal phases across historical bear markets. For example, September of 2000, markets gone up back 25, 30% from where they sold from March of 2000. And 2008 was similar when we had a significant rebound rally in the middle part of 2008. And I can go back to further examples where the return to normal phase is actually quite typical and quite similar when it comes to this cycle.
So can this pattern also play out in not just macro, but also micro? So you can see this cycle within like specific, like there can be many cycles within the cycle. Is that right?
That's exactly right, and that's the fractal nature of markets, right? So what you see in the micro is also in the macro, and but it's much harder and less reliable the smaller the time frame you're actually trying to analyze.
Right. Because we saw this play out with like many kind of crypto boom and bust while we were in just like this macro secular boom, but not just in crypto. There was other technologies that became hot very briefly and a lot of excitement, and then they kind of died off, and so it's all part of this much larger cycle.
And it's this idea that at the end of the day, as sad as it is, most retail investors lose money. So at the end of the day, the crowd is often not right, and we'll go into some of the reasoning for that as well. So the question we're asking is where in the phase are we? Some people say, well, this is really just the first sell-off, and we have a lot to go. Where some, and I'm in this camp, says that we're in this return to normal phase. So how do we analyze this? What are common characteristics for being in the return to normal phase? Well, typically it happens when you have a pretty large sell-off and people believe the lows have already been made, and it's just kind of up from here. You need a decent move up to convince people that we're going back to normal. It shouldn't be like, it's different from what we've seen in 2022 when we had we had multiple bear market rallies that continued to fall apart into new lows. This one has been lasting quite a long time, 6 months or so, maybe a little longer, and it's pretty strong. So people are now really believing that the worst is behind us. There's a narrative. A narrative has to develop to justify it. In this case, we have the AI narrative. But really, valuations have not gone cheaper. Typically in a bear market, in a normal bear market, smart money comes in because valuations have gone very attractive. But during the return to normal, the sell-off does not create lower valuations. It's just a sell-off because earnings are still decelerating and things are not getting cheap enough. And it's the reflexive behavior of the prior cycle that's really driving this. And then usually bear markets end with despair and capitulation, and people don't believe that it'll ever go up again, and they're completely giving up on it. Where in a return to normal situation, everybody's calling for a soft landing and everybody's calling for for a move higher. And it's actually very difficult to fight that because being a contrarian is a very, very difficult thing to do.
Yeah.
Okay. So a soft landing, I just want to point this out, is always expected. It's kind of a myth because it almost never happened. However, every economic cycle, people have always thought that a soft landing is going to happen. So I wanted to give you a few examples that I found from across the internet with different dates just to showcase this. Soft landing okay for the dollar, September 5th, 2000, right? We all know what happened after that. That's literally that was the return to normal because we topped in March, we had a big dip, we came back in September, and then everything fell apart immediately after. 1973, right before the big oil shocks and a 50% stock market decline, economists see soft landing. What about this one? Fed Chairman Ben Bernanke is credited with steering the US economy into a soft landing. They're able to raise rates and slow inflation just perfectly, and the US is going to be able to avoid a recession in 2008.
Pulled it off.
Pulled it off. Exactly right. And we can keep going, soft landing here, 1989, another recession, soft landing here, again, 1978, before another recession that hit in 1979. So it's not uncommon to see articles in the news and hearing people talk about a soft landing during the quote return to normal phase, because it's quite common. Like, this is actually what we should expect when we're trying to take this view to understand what is likely to come. Okay, so how do we actually know that this is more likely to end in a hard landing than a soft landing? That's really the key question. The sentiment and what we're hearing is just one thing, but how do we really know? So there are a few indicators that I look at that are quite interesting. This is one of them. And this is US tax receipts. Remember, most people are making the soft landing calls because they're looking at lagging indicators, things that have already happened, like the employment market. But there are leading indicators like US tax receipts. When US tax receipts start dropping really, really quickly, particularly below the 5 or 6% line, as they are now, falling over 7%. This is actually the biggest drop since June of 2020. There has never been a situation where the US has not entered a recession within 12 months when tax receipts have fallen that sharply.
Oh. And see, what's so interesting is this goes back to what you were saying earlier, which is like, price drives sentiment, right? So people look at headlines and people look at the price and markets, and then they form a narrative around it of like, oh, everything's great. And then when you say, well, let's ignore the noise and like, let's look at the actual data, this is what you start to see.
Right. And then when you look at it in psychology and historical cycles, you see that getting that sentiment extreme around this return to normal phase is actually common. Like, this is what typically happens. And then what makes it possible for the bigger drop to happen is because no one's positioned for it, which is something
right.
we'll cover later on, because they'll all have to position for it at the same time. So the tax recipients is definitely one. The US government finances, that's a little bit of a tangent here, but they are accelerating out of control, which I think will cause bigger issues in the years ahead. As you can see in this chart, these are deficits by years starting 2018, 19, and each one is color coded differently. And of course, COVID 2020 had a huge government deficit, and also 2021 stabilized somewhat in 2022, but it's really coming out of control. So government spending is accelerating as everything is costing more money because of inflation, but at the same time, interest rates are rising sharply on a huge debt load, which is a very, very bad cocktail. And interest expenses are continuing to increase. So imagine if we do go into a hard landing, what does the government have to do in that situation, right?
Right. It gets a lot harder to spend your way out of a crisis.
And they have to spend more because you need more social benefits because people are losing jobs. And at the same time, tax revenues are collapsing. So
right.
Tax revenues are already collapsing before any type of hard landing. So this is making it one of the most tricky situations I've ever seen. And when we analyze the income and outlays of the federal government, we're only bringing in 3.4 trillion in tax revenue, which is decelerating, but at the same time, we're spending more. I want you to look at this line item right here, which is net interest, which is right now sitting at just under $500 billion. One of the things people really don't seem to grasp is why monetary policy works with such a lag. Monetary policy works with a lag because a lot of the debt that has been taken in the prior cycle is fixed to a certain period of time. The more time passes into the new interest rate regime, the more loans are out there that are going to need to be reset for the new market regime. Currently, the US government debt is not that high, but within the next year or so, it would get closer to 4 to 4.5% interest expense. Now, what that would do to the US government outlays is quite dramatic because you could potentially double the net interest payments from 500 billion to over 900 billion on its way to a trillion within the next couple of years. Now think about it, that's very substantial because it might be the largest line item or very close to being the largest line item, and almost a third of the total tax receipts just going to pay interest on the debt. That is not sustainable.
Right. So you go from it being your sixth largest expense to your top one or two, while all your other expenses, they're not declining. They're likely, if anything, increasing slightly, and your revenue is being chopped. So if
Which is why,
yeah. So
yeah,
what are you thinking? I mean, if you're looking at this situation, right? Like, this seems like not a great situation to be in. You kind of backed into a corner, especially if the economy's potentially collapsing.
this is why I think the next round is going to be difficult because can we really spend our way out of it fiscally and monetarily the way we've done before, given how things in the debt load is already looking, and given where inflation already is, and whether or not we're going to get a second wave? People are cheering for inflation going down, but remember in the 1970s, inflation came in three waves, similar to COVID. One wave is very rare for inflation. You typically get a first wave, it kind of slows down, then you get a second wave. So it's a very tricky situation to be in ahead of a potential hard landing. So that this is why I think we really need to be paying close attention to this and how that looks like. And now you can see the projection of federal debt going forward just to keep up with how things are looking. And you are looking to get closer to 200% debt to GDP and much higher than where we were in World War II. So again, I'm pointing that out because I think we are definitely on an unsustainable path, and some difficult compromises are going to have to be done in order to get this in check.
All right. So we're seeing the Fed, not just the Fed, but we're seeing the U.S. government in an untenable position with it, the deficit growing and interest payments becoming a larger portion of that. That would lead us to believe that like interest rates can't necessarily sustain, this height, right? And what are the bond markets? What are the bond markets telling us? I feel like that's always the question to ask around this time.
Yeah, so let's talk about the yield curve situation. It's been an interesting market just because bonds and stocks have been saying completely different things about the future direction of the economy for the balance of this year, where the bond
Mm-hmm.
market is telling us hard landing is somewhat inevitable and the stock market's telling us everything is going to be fine. So historically speaking, bond markets tend to be right and stock markets are usually more optimistic. And what you're seeing here is the 210 yield curve. And the 210 yield curve is really the rate in which you're getting on your 2-year treasury versus the rate you're getting on the 10-year treasury. And historically speaking, you should get paid more for locking your money up for a longer period of time. So we really need to pay attention to what happens when the short-term rates are paying more than the long-term rates, because historically speaking, that always led to a recession.
Right. Because it's kind of an irrational move. You should always be rewarded for locking up your money longer. And when that isn't the case, you should be thinking something here is not right.
Right. And that typically happens when there's an expectation of recession. So institutions, for example, are going to prefer to lock their capital up for a longer period of time. They'd rather get paid 4% for 10 years than they would 5% for 2 years if they didn't believe that that 5% is going to sustain for a long period of time, for longer than a year or two. Because then they're going to have to just roll it over again, and they may not be able to get the same rate. So
Yeah.
the yield curve inversion is also a little bit of a self-fulfilling prophecy because it really hurts lending. So a lot of our liquidity in our economy is driven by the banking system, the fractional banking system. But banks don't like an inverted yield curve.
Right. I mean, it makes sense because they borrow short from consumers in the form of deposits, and then they lend it out long in the form of mortgages, which would be 20 or 30 years.
That's right. And you can see here that, going back here to the 1970s, we've never had a situation where the yield curve inverted at least this much and we didn't end up in a recession. Here's like the 2006 example, usually 12 to 16 months ahead. What's interesting, in 2022, markets sold off as this got inverted, but now kind of rallied into this trough at around negative 100 basis points. Usually the recession becomes imminent when the yield curve starts to disinvert, which is what we're expecting. And typically that happens when the 3-month bill over the 10 years starts moving the other way. Why is that? Because the 3-month bill is directly related to the Fed funds rate. And when that starts moving, it's anticipating imminent cuts, which tends to happen right into a recession. So you can see that happening here in 2001, 2007 to 2009. And again, really every other time. And usually when it gets this inverted, so again, the 3-month over the 10-year, it's almost negative 200 basis points, which is stunning. It's just the most it's been since 1981. Things get, recession becomes really, really high likelihood. This is actually put here into the probability of recession predicted by the curves from this model is created by the New York Fed. And it looks not just at the specific yield curves, but also the slopes of the yield curve. And you can see that the probability of recession by June 2024 is currently at 67%. And despite all the talk of soft landing, we've seen no drop in this whatsoever recently. In fact, the probabilities are continuing to go up.
Got it. So it seems like yield curve's telling us the same thing that the tax receipts are telling us.
That's right. And it's interesting as well to see that the probability of recession now is higher than what it was in 2007, 2008. So
that's right.
It's as high as it was in the early 1980s. It's just something to watch into that. Okay, so now let's talk about leading economic indicators and what they are telling us about recession. If you notice, the theme here is I'm not talking about the labor market per se, and I'm not talking about inflation per se, because they are not leading indicators. I'm just trying to look at everything that's telling us what's likely to come ahead instead of telling us what already happened.
Yep.
So in the leading economic indicators, here's really what they are, and we're going to break them down into the kind of LEI change. So what does that comprise of? We have the financial component of it, which is credit index, which is deteriorating, right? As I mentioned, there's less lending going on. Banks are less likely to loan money, etc. We have the S&P 500, which has had a positive signal here because it's going up, but it's negated by a lot of other things, such as the interest rate spreads, what we're talking about with the yield curves. And we also have non-financial components. We have expectations for business conditions when managers are asked, are you seeing more sales, less sales? What are you expecting going on? Very negative. New orders. So new orders is a big one because managers, imagine you're a manager in some company, could be the Gap or any other big company. I'll just give an example. You need to anticipate what kind of sales you're going to see in the next quarter, in the next 2 quarters, and you're going to make orders based on your expectations of what's happening because you don't want to get stuck with too much inventory. So these managers should have a really strong pulse into what's going to happen to the economy because they have more transparency into their own business. So in an aggregate of them are starting to drop the amount of new orders, that's a bearish signal because that means that consumer spending is going to be down because they're expecting less transactions to happen. And then we also have the housing market, which has now been flat. New orders for manufacturing more or less flat. And then you put it all together to create a chain of leading economic indicators. So let's look at how that looks like. So here we go back to 2000, and you can see the year-over-year change of the leading economic indicators in blue, LEI, and then you can see the year-over-year change of real GDP. And it's interesting that the correlation is really strong. Leading economic indicators typically lead the real rate of change in GDP as well. Quite a bit.
Yeah, so it's interesting because it shows that entering 2008, we were at negative 5%, and we passed that mark earlier this year. So we're actually well past that already.
Well, yeah, for LEI. So LEI got into, yeah, you're right. LEI got into negative 6-7%, then GDP followed a few months later. So right now, GDP is just getting very close to the zero line. LEIs are predicting quite a substantial drop in GDP, which would obviously lead to recession. Another way to look at this is where the signal is, kind of like the warning signal right around the negative 4 area. Once you pass the -4 area, historically speaking, we've almost always had a recession. And right now we're trading around that negative 8 area as of May.
Yeah. Yeah, and it's an interesting pattern. We see these kind of the shakiness, kind of like we did with 2008, right before it took that second large decline. Um, but yeah, we've passed the threshold, to say the least.
We have passed the threshold. Another way to think about it is how that relates to employment. Employment, everybody points out of the strong labor market, which I agree, the labor market has been exceptionally strong and resilient, but the labor market is a lagging indicator. So when we're looking at payroll employment, one of the first ones to react to changes in the economy is actually temp work. So temp help services. And you can see that that's a lot more sensitive to changes in the LEI that we see here in red. So LEI is falling quite a bit right now. We're starting to see a drop in payroll employment as well. And temporary employment, and that leads more full-time employment as well. So that's definitely something we need to watch for, because the Fed fund rate does has a strong correlation to this US job opening versus unemployed people situation.
Mm-hmm.
And usually it correlates with the Fed fund rate. So it's interesting that when the Fed is expected to cut rates is usually when the unemployment gets a lot worse. So they're cutting
Right.
rates in response to a deteriorating economy. They haven't cut rates yet, but they're probably close to it, or close to at least stalling. And when that happens, the employment numbers tend to kind of roll over. We're seeing a little bit of a rollover right now, but just not enough. And a lot of people talk about the Fed policy mistake, et cetera. The Fed is always lagging, right? The Fed is responding to what they're seeing right now, but the consequences of what they're doing is typically seen months
Mm-hmm.
into the future, if not even longer. And in my opinion, right now is the time that the economy is approaching that stall speed and about to just completely roll over. Technically speaking, the Fed should be cutting rates yesterday in order to avoid that
Right.
to happen. But clearly, they're not going to do that. So this is what we're watching for. And the employment number is really, really important. Why? Because a fast deterioration in the jobs market creates massive equity market drawdowns.
Yeah.
You see that in 2000, you see that in 2007. COVID obviously was a little bit of an abbreviation. So now we're
Right.
starting to slightly go up here.
We're
And the
seeing
big
this.
question
Yeah,
is,
we're seeing the shift.
are we about to enter one of these periods? And that's going to be very important for equity markets and other markets as well. This chart goes back to the 1970s. And lastly, I want to leave you with this chart on this LEI front between 2019 and 2023. Stock markets do tend to look at LEIs quite significantly and tend to trade in the direction, because the stock market is supposed to predict the economy. But we've seen a real breakdown in 2023 when economic conditions continue to deteriorate in at least the leading economic indicators. But lagging indicators as well as coincident indicators are very strong, and the market has just been ignoring LEI in 2023, which is quite rare, honestly. But we've seen that happen.
So this is basically showing us that there's been there's started to become a large divergence between the leading indicators, which are almost all in decline, even sharp decline in some instances, and yet the market is stubbornly pushing upwards.
Correct. The market is stubbornly pushing upwards, but and we'll cover the reason for it. So inflation slowing down is also quite expected, because as the economy slows down and stalls, there's less consumer spending, and inflation should slow down, right? So it is something that is normal, that happens ahead of recessions. But I will point out that services is still sticky. Most of the decline we've seen over the past month comes from energy prices and food prices. But we're still seeing, services is slowing, but it's not slowing as fast as the Fed would like. And I think it is a tricky situation, because if they do ease too quickly, inflation certainly can come back. And given what we've seen with the government debt load and other debt loads and the way monetary policy works, I just think it's a very, very volatile macro situation, which I think the market is just massively underpriced.
Yep. No, it makes sense. So I know one of your favorite things to talk about is liquidity. What's the liquidity signal? What is that showing us? What should we expect?
Yeah, so with M2, there's nothing new money supply. So this chart goes back to the 1980s. post-COVID, we saw the fastest expansion of M2 really in recent history, where almost a 30% positive rate of change. But falling off a cliff, this is really the first time since the 1930s where money supply has gone negative, which typically is not good for financial assets in general, not just stocks, but real estate and everything really. And if we're seeing that in the housing market where things have slowed down significantly. New home sales are down quite a bit. Prices are not down, however, because the market is relatively frozen, but mortgage applications are down a lot. They're really down back to 2013-14 levels, so quite a bit. And that just shows that there's less money going around, liquidity in the system, and it shouldn't be a surprise as we're seeing on a relative basis, the mortgage rates are the highest they've been, even surpassed this 2008 period, looking at the spread between the mortgage rate and the 10-year treasury. So mortgages, I believe, are just over 7%. This is my favorite chart, something that those of you who have followed me have tracked this for some time. Usually we just show the Fed balance sheet versus the stock market, S&P. This time, this model is far more accurate because we're looking at global liquidity as measured by the Fed, the ECB, the Bank of Japan, the Bank of England, the Bank of China, Bank of Korea, Bank of Canada, Swiss National Bank, et cetera, et cetera. You're literally taking all the central banks around the world, you put their balance sheets together. And I was stunned to see that the R-squared correlation to asset prices was 98% since 2009, which is just stunning.
I'm surprised to hear you call it your favorite chart, because like that's like picking a favorite child. You're constantly looking at all the data and all the charts, and for you to say it, tell us why. So not only is the correlation so high, but what do you think? Why is it so tightly coupled?
Yeah, because I think that since the financial crisis, it's really liquidity what's been driving most, margin and expansion and equities and things, and really economic activity. It's been a big shift since the financial markets because central banks have been so supportive of markets in general. And understanding liquidity, quantitative easing, quantitative tightening, I think is material for investing in today's world. Understanding central banks is more important than understanding a company's balance sheet, I would say. Right. Because at the end of the day, a business is a great business, but it works within the framework of the broader economy and how available liquidity is. And we did see a decent spike in liquidity after Silicon Valley Bank. So it was really tough to determine in real time whether that's going to turn into full-on systemic risk or central banks will just use it to create some more liquidity. So they did use it to create some more liquidity that did support the markets over the last 6 months. However, that liquidity is completely rolled over and actually made new lows. So we're seeing quantitative tightening primarily in the Fed as well as the ECB. We're not seeing that in Bank of Japan, for example, but we're seeing more tightening liquidity conditions around the world. And I usually don't fight the Fed, right? Fighting the Fed is a horrible advice, whether on the upside or the downside. When the Fed is massively expanding the balance sheet like they did in 2020, you don't want to fight that, right?
Right. No, of course not.
And when the Fed is contracting the balance sheet, you don't want to fight that as well. And when a chart has a 98% correlation to asset prices, it's something I tend to listen to. Obviously, correlation is not causation, but it definitely has some sort of very strong relationship. Here you can see the weekly change in billions, and it's very negative, and it turned very negative very recently. So again, something we're watching for. This is reserves. This is just the Fed reserves versus S&P. This is the shorter time frame. So here you're starting 2019. Here's this COVID. Here's the reaction to COVID, massive expansion, 2022, and complete breakup since AI came through, which has pushed the S&P. If you take out the AI stocks, S&P would be right here where it should be. So we'll talk about that in a second.
Well, and so just to put a cap on this section, back to your, talking about your favorite chart. So we started to see on that chart, you could see at the very end, it's diverging where markets seem to be pushing up and liquidity is has crossed and is going down. And I'd say the key thing there, based on my understanding, is that it's not just going down a little bit, but the projections is for it to continue declining at an accelerating rate over the next 6 to 12 months. Is that correct?
over the next 2 years, right? Because we have
Mm.
95 billion of quantitative tightening just from the Fed. We also have the Treasury General Account, which basically is issuance of new money from the Treasury. So the Treasury, after the
Mm.
debt ceiling, has to replenish its coffers, and that's putting a liquidity drain as well. So we can project that, and we can see over $1 trillion disappearing from these balance sheets, which, again, is one of the reasons where I believe the environment is actually quite tight. And if you exclude AI stocks, I mean, a lot of the markets are already reflecting that. Bond markets are
Yeah.
reflecting that, but it's an interesting divergence because it's one of the larger ones that I've seen, really.
Got it. Okay.
Okay, so let's talk about earnings because that's also somewhat important. A lot of this idea of, okay, return to the new normal. Um, when you study history, it shows you that people are buying into higher valuation. They're not buying into, typically after a bear market, it's good to buy because valuations are a lot more affordable. And then companies there's a lot more room for error and the valuations is much better. But we have seen global earnings revisions continuing to go down since June of last year, whether it's in the S&P, in the European stocks, even in Japan and just emerging markets as well. And it's just interesting that the majority of what we've seen really in 2023, we've seen some valuation decline here in 2022, but then the entire IT sector is just experiencing huge PE expansion, which, is interesting given trailing EPS. And when we look here into the 25% gain for the whole S&P 500, since last year, since really October when the market bottomed, every single penny of it was driven by valuation expansion, by PE expansion, and none of it has been driven by earnings growth. Zero. You can see here earning growth has actually been negative since last year. And the PE valuation in this chart is in orange, where the price is in blue. It's all been PE expansion, which is quite unusual in a period of high interest rates. Usually these PE expansions happen when interest rates are lowered and there's less alternative for your money. So you're chasing the same asset is priced higher. So seeing valuation expansion into rising interest rates is rare. And it means the market has the expectation that in the future earnings are going to grow much, much, much faster.
Got it. So it's more what you would expect in a mania or in a bubble, the type of behavior where earnings are declining and yet valuations continue to rise.
Right. And here's another way to look at it, where most of this valuation expansion is coming from what we call the magical seven, the big seven, where for the first half they went up 70% or so, and they've reached a 37 PE valuation for those mega caps, which is a lot more than the rest of the S&P at 19, or small caps are fairly expensive at 22, but they've really driven all these gains and they're becoming quite expensive. And the historical relationships between what the S&P would do and, let's say, interest rates. In this case, you're seeing the 10-year tip yield inverted. So tip yield, Treasury inflation protected securities, is a way to think about the real yield. And as the price of money goes up, typically growth companies should be trading lower because there are substitutes for where you can invest your money. You don't have to take that risk. But we've seen in 2023, this is really since ChatGPT came out, where the quote price of money has gone more expensive, but the valuation and the price of all these companies has increased dramatically.
And so this divergence between equity prices and the yield, like this curve, or is this one of the core trades? Because I know you talked about like trading this divergence because it's bound to normalize, correct?
Yeah, so when you think about what we trade in alpha, for example, we don't necessarily trade just price, believe this will go up, this will go down. We trade macro relationships really as core themes, which is why we can achieve uncorrelated returns in the long run. And this is one of the key relationships we traded. We put this trade around, April, May, when we already saw this being quite divergent, and of course it accelerated. One of the key things we have to do is manage risk in a certain way and understand how to trade these spreads. But the yield curve is certainly one of the things we trade, as well as this relationship is one of the things we trade. And we trade this absolute relationship. So in this case, what you would do is you would short the red line to simplify things and kind of buy the black line and wait for that to go back to normal. And obviously over the last couple of months, that has not been the case, but we believe that the opportunity for normalization can create some excess returns or outsized returns for alpha when it does happen. Because multiple expansion is not very logical during a period of rising interest rate, and you can see here that the bond market is saying that rates are not going to sustain into next year, and they will be cut dramatically, likely in response to a coming recession.
Yep. So it looks like the market's telling us that rates will be below 4% by the end of next year. That's pretty wild.
Right. And for the first time in a long time, there is alternative. So typically this type of behavior is something that you saw during the period of easy money. This is the period of easy money, right? So in this period, the dividend yield on the S&P 500 is far above the prevailing interest rates, right? For a long period of time. But we have the highest risk-free rate since 2005 or so. And typically during that time, both valuations and this type of multiple expansion does not happen, because the logical thing to do here is to move from equities to bonds, right? Because you have a very reasonable alternative to buying expensive stocks, right?
Yep. This is capital seeking alpha, right? So you would expect that capital, it's like when there's a risk-free rate that high, why wouldn't you take that over such a relatively low, meaning the risk in the S&P isn't justified by the return.
Right. So do you want to buy a bunch of stocks at a 37p valuation, or do you want to wait it out at 5.5% rate? So logically, you would prefer the risk-free rate, but during a euphoric phase where people are chasing returns, you would not. So this is exactly what we're seeing in this chart. So the spread here between sentiment trader, they track optimism indexes in both stocks and bonds, and then they compare spread between them. So currently, investors prefer stocks over bonds by the greatest extent in 24 years, which is exactly the opposite of what you should logically be doing
given the rates.
Given the rates. So, we're looking for euphoria right now. We're looking for that return to normal sentiment. We're looking to feel contrarian. We're looking for, all the news to say a certain thing. And it's supposed to be very difficult to be contrarian right now. And that's exactly what we're seeing across the board. Again, this is another way to look at that spread that we're trading right now. One of our core trades in alpha is really betting on that spread to mean revert, because you have the NASDAQ 100 forward P. A way to express that is with options or shorting the NASDAQ. And the other way to express the tip yield is to go along the long bonds, expecting that economic slowdown, the yield curve will go back to normal, the economy will slow down into a recession, and yields on the long end will drop. So there's a lot of convexity in that trade if and when it happens. Clearly, it's difficult to time it exactly. We were actually quite a little bit early getting in around April and May, but nonetheless, we believe very much that this spread will come in. And we trade relationships versus necessarily just price. And trading relationships has a much higher probability of success, just because historically they always go back to normal.
And we always urge caution, though, because what separates the, terrible from the excellent in terms of performance is your ability to control risk and being able to sustain while divergences like this perhaps get more extreme, keep the positions open while controlling your risk. And that's very hard to do. So again, we caution, don't try this at home. This is not investment advice, but it is informing our view on markets, which is that when you look at this, it appears for a brief period of time, the market has decided to ignore the financial reality that it exists within. And so we're seeing this, divergence exist, and we don't think it will last.
That's right. But again, things can normalize in a few ways. You can either have the bonds really being wrong and interest rates going down significantly, and then the NASDAQ just stays where it is. It could be the other way around, or they can meet somewhere in the middle. So one of the things to do it is we can't just say, oh, we're short NASDAQ, because that's, relatively risky. But if you're taking the other side with the bond, the bond side may be wrong, and then the spread will close that way. So it's really a matter of,
Right.
figuring out the spread will close. In which way is it going to be? We lean to think that it's more or less going to close in the way of the Nasdaq falling, but we don't know that for sure. So you have
Right.
to be able
Right.
to execute the whole spread correctly. And this is really what I wanted to show, that this chart, without AI, the S&P would not be so far from where the Fed balance sheet and liquidity is. With AI, the S&P this year is at 4,400 and change. Without AI, it only would have been at 3,900 or more or less flat. So literally, these stocks have driven all the year-to-date gains, which is just stunning.
So is AI the new tulip or is it the new crypto?
That's a tough question. Now, again, of course, AI has some real. You know what? I'm just going to ask ChatGPT.
That's the answer to all of our problems.
ChatGPT is going to solve the world. So um, again, I'm sure AI has real strong use cases and it's going to make a lot of changes in the world, but is it already priced 10 years ahead before we figured out how to properly adapt it? That just seems that's a recurring motive with a lot of these type of things. And you can see the crowd is definitely chasing it, and it's chasing it pretty strongly. Flows into tech are higher than what they were in 21. It's really crazy. Um, Massive flows into tech. And the gap between the performance of equal weight S&P, meaning like if every stock was worth the same, had the same vote in the S&P, versus the cap weighted, which is what we have it today, where Apple is a huge part of the market, Microsoft's a huge part of the market, is the largest it's been since an extremely long period of time. Here's another way to look at it. The concentration level of the market is in the 99 percentile, and the market weight of the top 10, meaning all the AI names like NVIDIA and Apple and Amazon and et cetera, um, are at all-time highs. So we've only seen that right after COVID and then in 2000. So it's just a condition that we really need to be watching for as we potentially have a concentration bubble in full flight.
Yeah, everyone's crowding into the same trade, chasing the same names, and it makes sense. Exuberance is so high.
Yeah, in fact, the spread between the top 7 stocks compared to the rest of the index is higher now than it was when the dot-com bubble actually bursted, which is just crazy. Over a
That's really
40% spread.
interesting. Yeah, so that's an expression of the zeitgeist, right? Everyone gets so excited, they crowd into the same trade. It creates massive concentration, drives markets higher, which drive headlines, drives sentiment, like we said in the very beginning of the conversation. And so what happens next, right? Well, let's show us the
Well,
last few data points. I know we're getting towards the end of the story here.
yeah, another way to look at it, to make me feel like, okay, here's what makes me feel good about my belief as a contrarian, where, it's really hard to be a contrarian right now because you feel kind of like a fool. Everything, oh, it's going up without you. And, you see the media and you read the news. This is the hardest time to stay true to your conviction. But I use data and I track it every day. And that's what keeps me sane and keeps me from making what I believe is some of the mistakes of trying to chase performance, especially during these times, because history shows that it ends very badly when you do that. Financial markets you miss one train, there's always going to be another train. And you need to do it right, and you need to follow it right, and you need to follow the data. And chasing for the name of chasing may make you money for a month or 2 or 3, but it usually doesn't end well for the average investor. So another data point to look at is the weight of those top 10 names in the S&P today is almost 32% as of June 30th, which 10 stocks are accounting for a third of the entire stock market, but are only accounting for 20% of its earnings. So you're already seeing this divergence with valuation being certain. That's a 50% delta.
Yeah.
So that's quite a bit of data point. And of course, when you're looking at that fear and greed indicator, market's currently trading within extreme greed. We're seeing that with what we call the put to call ratio. So what is the put to call ratio? It's the idea of, are people favoring puts over calls? Calls, of course, bet on a market upside, puts bet on market downside. It's an interesting contrarian indicator because typically when everyone is favoring calls, we're not so far from a market top like you saw here in 2021. When everyone's favoring puts, we're usually within some kind of market bottom. Because the reality is that you should buy puts not when you need them, is when you can. But when the market's going up, no one's interested in buying puts because everyone's only thinking about upside. The way it works is it's an interesting contrarian indicator. And the idea here is that if everyone's already long the market, who's left to keep buying it and pushing it higher? And if everyone's already out of the market, who's left?
Right. So if the market indicator is showing extreme greed and no one wants protection during the time when this is likely when you need it the most, it's a good sign that perhaps it's running out of steam.
And you can see it here, positioning in U.S. equity futures by asset managers. Everyone's back to being long. They're basically, in 2022, people were basically not long. They got caught off-sided. Positioning really increased over the last month or two, massively. And right now, we're actually above where we were in 2021 as far as positioning. It's kind of crazy.
What a shift. I mean, that indicator was showing fear, maybe even extreme fear, not that long ago.
As you said, is it sentiment that drives price, or is it price that drives sentiment?
Well, I think it's price driving sentiment.
Right. So chasing performance, people are seeing the market going without them, getting the FOMO, and investment managers, hedge fund managers are not immune from that. They're, they still have their human emotions and they feel left behind, and they can't afford to miss out. So really, the last thing I
was gonna say, I love when I hear you say they have human emotions. Itay's like, this is not a problem I'm troubled by.
Fortunately, it is not, right? I try to make it as database as possible and not let I've learned in my career that FOMO is not a good investment strategy, right? Basing things on data, historical spreads, things that have worked over time, while controlling risk is a much better investment decision in the long run, right? In the short run, over a month, 2, 3, sure. But in the long run, it's staying in the game is all that matters.
Yeah. When the tide goes out, let's see who's wearing shorts, right?
Exactly. So, and again, that's not to say that something like this can't last for a long period of time. Look at 1999. That lasted 14, 15 months, and a lot of very smart people got very frustrated. And famously, Stanley Druckenmiller bought the top after he couldn't take it anymore because he was out for the whole period. And he said he bought the day of the top, and it cost him something like $12 billion. And when they asked him, what did you learn from it? He said, nothing, because I knew I shouldn't be doing it.
It's great.
All right. So there's a lot of. So where does it leave us? The key question is: it fading out? ChatGPT, OpenAI actually is falling as far as visits and subscriptions over the last month or so. Just something to watch out to see if this hype is actually fading or not. And of course, I leave you with this again after our whole conversation. Where do you think we are here?
Well, if I look at this chart, it's kind of like one of those tests they give you at the eye doctor: A or B.
And this is of course going back to 2015. The big question is this move back up here? Is this basically this return to normal phase or not? Remains to be seen, but it is I've been wrong before, clearly, and things can last longer than they have. And in some cases, the return to normal can even exceed or get towards a new high. We saw that in 2000, where in September of 2000, we basically retested the highs from early 2000. So it doesn't mean that it has to be that much lower than it, but the pattern is still very similar. Something we watch for, and unless the macro fundamentals, leading economic indicators really improve, I think the risks are substantial. So like the Fed model, I think it is in the 70-75% chance that we do end up seeing this hard landing, given what we're seeing with the leading economic indicators. And again, the biggest thing here is not to confuse the lagging with the leading. So I'll leave you with those thoughts.
Yeah. And so I would say, based on our discussions and what I've heard you talking about with the asset management team, this is a time to exercise caution, be diversified, And I know it's difficult to ignore the headlines, but I think this is a good reminder to remain grounded in the data. See them both as I mean, each are data points, like sentiment, right? You said price, sentiment. These are data points, but we have to compare and contrast that with what the leading economic indicators are showing us. This is a great tour de force of the latest in the state of the market. I'm sure a lot of people are going to have questions, so feel free to email us, founders@equi.com. And until the next time we talk, the question remains, is this the return to normal? We seem to think there's a high probability it is. And yeah, we want to hear from you. So we'll talk to you all again soon.
Thanks, guys.